Welcome back, everyone. I hope you're all having a good day today. Today's video, we're going to be going over what I believe to be the very best investment that anyone can make, that being an ETF. I truly believe that this is something that every investor should have in their portfolio, if not all of their portfolio into ETFs. So here we are, let's get into it. Why do I believe that investors should choose an ETF? For one, they have the best track record historically. They beat real estate, they beat gold, they beat silver, they beat any other asset class on earth over a long period of time. ETFs are the very best investment on average that you can invest in over a long period of time. So if you're investing for the future, if you're investing for retirement, this is the best option. Nothing has been able to beat it in the past, and I don't believe anything will beat it going forward. Just for an example, here is real estate versus large cap stocks, which is basically ETFs is what this is showing from different time periods, and over every time period it has destroyed real estate, although I do believe real estate is probably the second best investment just for the leverage that it allows for you to, put 20% down and slowly build the equity in that home, receive rent payments. It's still a great investment, but I do believe that an ETF clearly smashes it in terms of accessibility and total returns, as well as ease of investment. An ETF is an exchange traded fund, which is basically a basket of assets, typically stocks, but it can also include things like bonds and commodities, as well as other things that follow an index. The one you hear most popularly is the S&P 500. There's also the NASDAQ, the QQQ. And basically those indexes, they set their own strict and complicated set of requirements that pick stocks based off of a wide range of criteria and methodology. And so they'll basket them into, growth, value, or dividend stocks, or large cap, mid cap, small cap, micro caps. And it can be sorted by regions, like it could be a US index, it could be a total world index. And basically those indexes, they recalculate every year or so, sometimes 6 months, sometimes every quarter. And they make sure that the companies that are inside their index meet the parameters, and any stocks that no longer meet the parameters, or if there's other stocks that are performing better, sometimes they're kicked out and they're replaced with better stocks, companies that are predicted to perform better and have been performing better. For example, here's how the S&P 500 does it. They rank companies from 500 and above based off of market cap. And they put those into large cap, and then mid cap, 500 to 1,000, small cap, 1,000 to 2,500, micro cap is 2,500 and lower. And they also value them off of growth or value here, as you can see, by 6 different points. They have projected price to earnings ratios, projected earnings growth, price to book ratios, dividend yield, trailing revenue growth, and trailing earnings growth. And they have a system that ranks them off of these 6 points, as well as whatever large, mid, small cap that they're in, and the index basically formulates itself like that. One thing that's severely underrated with ETFs is you can begin investing with as little as $5 due to fractional shares. Most brokerages at this point have that. I know Robinhood does. I know Fidelity does. Honestly, Schwab probably does. I think most of them do at this point, where things like real estate, gold, silver, and even some bonds, you have to save up a decent amount of capital, especially for like something like real estate, 20% down. On a $300,000 house, that's 60 grand, or gold and silver. Sure, it doesn't take that much, but you still need some capital. Whereas an ETF, if you're just getting started out, you can start with a few bucks. You can get the ball rolling early. You don't have to think too hard and sit on a pile of cash before deploying that capital. So that's one major advantage for sure for ETFs. Another important point for ETFs is they typically grow intrinsic value over time. Well, historically, they have always grown intrinsic value over time. Comparing it to an asset class like gold, silver, crypto, any other speculative investment, you're essentially buying something and you're hoping that someone down the road will pay you more than the purchase price you paid for. So I like to treat these as almost as buying vintage art or baseball cards or any kind of collectible. We're sure they can return value, but you're speculating and you're hoping that someone is willing to pay up in the future, where if no one is willing to pay, you're basically stuck with that item. So say you buy Bitcoin and down the road, no one is valuing Bitcoin nearly as much as it is today, or maybe the market for Bitcoin is completely gone. So your money has turned into Bitcoin that is no longer liquid. You never know what's going to happen. Sure, crypto could go to infinite, but it doesn't have any backing. It doesn't make money. It doesn't have any real intrinsic value. Now, how do we know ETFs will continue to succeed in the future? This goes back to the intrinsic value of the assets continuing to grow. These businesses are very powerful. They're always growing revenue, net income, cash flow per share over time. Especially for the ETFs that I prefer, the large caps, they are some of the most successful businesses and successful business models in the world, and they continue to make money for shareholders and the ETFs that are invested into them. ETFs are also self-cleansing in a case that if a business were to make a change for the worse, these indexes, they're always surveying and making sure that the companies within the index are maintaining strong future outlooks to return value to shareholders. So if a company starts going downwards, something happens in their sector or their business to where competition has come in or regulation has come in and they're no longer projected to make money in the future, if they've already stopped or slowed, those companies will be kicked out. Essentially, the index will kick it out and they will replace it with another company that has a bright future. So you don't have to worry about, companies going to zero in an index. The index will get rid of it. And this is all automated, so you don't have to worry about, an active manager preferring to stick one out, or if they believe a company will turn around and they never do, it's going to be kicked out immediately by the index. It's basically a computer. It's not a person. So you don't have to worry about anyone getting attached to an investment, and you shouldn't either. So now, what kind of exchange traded funds should I invest in? There's really so many great options. There are hundreds, if not thousands, of quality ETFs to invest in. For the great majority of investors, I think that they should simply pick one large cap US based index fund and invest all of their extra capital and savings into that on a regular basis, especially those that don't have, millions of dollars, so they don't need to diversify into real estate. If you're just a normal person like me, you should just simply stack your money into the best companies in the world, which belong in the United States. There are a few abroad, but for the most part, the United States is the best of the best. The US is basically a breeding ground for the best businesses in the world. We have the best business models, the best business regulation. And unless we see dramatic changes to American capitalism, this will continue to be the case in the future. America also has the strongest economy by far. It's not even close on a per capita basis. And it's even the strongest, overall. So, and it has some of the most business-friendly regulatory practices for large businesses in the world. It's very friendly for any kind of business, but especially large businesses. A lot of places are really, really harsh on these businesses. The EU is pretty harsh. There's other parts of the world that are also very harsh that kind of hold these large businesses back. Here is just an example of that. This is from, I believe, 93 to 2025, late 2025. This is the S&P 500, so the US top 500 companies, essentially, versus the MSCI's version of this, excluding the United States companies. And you can see a $10,000 investment from 93 to 2025 invested in the United States would be 280 grand. And if you invested into the rest of the world, you would be sitting at 68 grand. So, sure, it's still a good investment, 10 to 68. It's not great, but it's a lot better than sitting in cash or probably even bonds. But as you can tell, America is king when it comes to the stocks and the best companies in the world. I think investors should do a little bit of research into an index and understand the methodology. You can check out a couple, of course, but just I believe look at some of the most popular ones: SCHG, VOO, SPY, even QQQ is a good one. SCHD. They all have different methodologies. They all have different ways of picking stocks, picking companies. They're different sizes, different market caps. So just do some research, pick one that you believe will do the best in the future, and then pick an ETF with the lowest expense ratio that follows that specific index, and simply continue to focus on allocating more and more in capital into that ETF and let it compound for you year over year without having to worry about any market noise, any headlines, anything. This should be non-distractive. Since you're not investing in the specific companies, you'll be in different industries, and it's going to go up over the long term. So it might go down, it might go up, it'll be sharp, there'll be volatility, but if you don't look at it, you don't focus on it all the time, you will be compounding year in, year out. A lot of people ask why not go for higher returns with a riskier investment like individual stocks or even, things like crypto gold. Um, and the reason is a great majority of investors over time have found that simply beating the S&P 500, which is what everyone invests into, you hear all the time, that alone is a near impossible feat over an extended period of time, over a decade, 2 decades. It's near impossible for people to do that. Only the best of the best and the most disciplined investors can do it. Therefore, putting your hard-earned money into some of the strongest businesses on the planet and allowing them to work for you instead of trying to find a quick win will always be the smartest thing to do over the long term. Investing in individual stocks can be a great investment also. However, stock pickers and market timers continue to get absolutely crushed by the indexes year in and year out, simply slowing down their compounding snowball towards financial success. So if you were to, think you knew something that others didn't and you make a speculative, short-term move, and say you only lose 5%, but say it's on a year that the market went up 10, 15%, you've essentially lost, 2 years of compounding. And time is the main thing that you have when investing. I really employ, the younger you are, start now. Don't wait till you're 30, don't wait till you're 35, don't wait till you're 40, start now. Because the time, it really, really is impressive how much time can help investments. And most investors should simply focus more on saving extra funds and working on growing their income instead of trying to edge out extra return that often end up backfiring. So instead of, spending time looking into stocks, looking into businesses, unless you are very serious about it and you have, discipline, I believe that most people should worry more on income and saving, living below your means, spending less than you make, and just simply letting the economy and these strong companies build your wealth over time. Here we have the SPIVA US scorecard. This is posted by the S&P 500. This is actually from 2024, but here it says, in an environment characterized by large cap dominance, it was not surprising to see that the majority of actively managed funds underperformed their assigned benchmarks in 2024. Fixed income managers had a mixed year with pockets of high outperformance. In our largest and most closely watched comparison, 65% of all active large cap US equity funds underperformed the S&P 500, worse than 60% rate observed in 2023 and slightly above the 64% average annual rate reported over the 24-year history of our SPIVA scorecards. Across asset classes, underperformance rates typically rose as time horizons lengthened. At the 1-year horizon, 7 of 22 equity categories and 11 of 16 fixed income categories saw majority outperformance. Over the 15-year period ending December 2024, there were no categories in which a majority of active managers outperformed. And then here at the bottom, it's just a little chart, percentage of large cap domestic equity funds underperforming the S&P 500 each year. And as you can tell, pretty much every year the S&P 500 outperforms. There was 3 years where less than 50% of domestic equity funds didn't underperform, where still 45, 48, 49% of them did. So over time, every year the average is around that 60, 65-ish range of percentage of large cap domestic equity funds underperforming the S&P 500. It's very strong over time. Lastly, should I invest in ETFs in any financial situation? I believe absolutely not. If you're in any kind of consumer debt, car debt, student loan debt, or any other debt that isn't a mortgage, you should first focus all of your efforts and extra savings at paying off those balances before even adding any capital into investments. This might not be the most mathematical approach or, efficient approach, but I believe that if you are distracted and you have too many things going on at once, you're not going to get anywhere anytime soon unless you're basically a robot that doesn't, have any psychological effects of having debt. So not only does this simplify everything and give you peace of mind once the debt is paid off, it can also be seen as a motivating force, knowing that after your debts are handled, you can then invest extra money that you haven't allowed to simply get to work for your future self. So that's a great point. If say you have $15,000 on a car that you owe at a high interest rate, say, and you're saving $1,000 a month extra after all of your expenses, after 15 months, you'll be able to invest. But if you know that once that car's paid off, you might, put $100, $200, $300 extra every month towards that car, towards whatever debt you have. And it's almost like a reward that after you get out of debt, then you can start compounding your net worth, start growing, and start because every dollar after your debt's paid off is basically paying yourself in the future. One last point here is if you need money within the next 1 to 2 years, whether that is for retirement purposes or a down payment on a house, do not invest and instead put that money away either in a CD or high yield savings, as the stock market can make a steep move down at any given time, and that can put you at risk. So, I mean, if you plan on buying a house within, even if you don't know a specific date, if you know it's within 2 years, something like that, do not be in the stock market. No one knows what the stock market's going to be over 1 to 2 year basis, but we do know over the long term it's going to go up. Let's take a look at a compound calculator. This is one of the main things that got me really inspired to invest over time. Let's just say you're starting with $0. So $0 invested. You invest $200 a month. At the average index return, around 10% of the is what the S&P 500 gets. Let's say you're 25 years old, so you retire 65, and boom, $200 a month, over $1 million by the time you retire. You know, truly incredible. Let's say you're 35, so you have 30 years. That's still $450,000, only $200 a month. That's it. All you gotta do, automate it. Your brokerage can do this. Have $200 come out the same day your rent comes out, your mortgage payment comes out, whatever. Treat it as your rent or your mortgage went up $200 a month, so you're forced to save that money. You don't have to think about it. You don't have to think about the market. It just comes out. And let's say you get serious about it. $500. If you're 35, you might have to do $500 if you want $1 million by the time you retire. Let's give you 40 years again. So say you're 25, $500 a month, $3 million. You know, I mean, it's not that hard. That's what 10% a year does. And people can say inflation this, inflation that. I promise you $3 million in 40 years is a lot more than $0 in 40 years. Or if, like, look, let's say 0% interest rate, right? That's all you have. That's all you invested. You invested 240. You invested 240,000, but since you get 10% a year, that grows to over $3 million. So, the younger you are, please get started. Don't start in a few years. Please start today. Time is your biggest beneficiary of investing. Like, look, 40 years, 3.1, just one more year. Boom. Insane. So I really recommend getting started today. It's insane how powerful this tool is. So that's going to be it for today's video. On your way out, don't forget to subscribe, and I'll see you next time.